Over the past 30 years, I have seen more definitions for fair value than I thought possible. When I entered this wonderful industry, knowledge of fair value was claimed by many with a high degree of confidence, or maybe I should say hope. Everyone thought they had a better way of determining this magical number, but the more I researched the topic, the foggier the concept became. Fair value is under the assumption or possible misconception that the investor, 1, has a reasonable level of knowledge about stocks and markets, 2, seeks to advance their financial interests positively, 3, are not under pressure to act one way or another, 4, can execute a transaction in a reasonable amount of time, 5, the information is accurate and truly reflects the market. These are reasonable and necessary assumptions to make when we are attempting to figure out how decisions are made when we sit in a laboratory. It works well in theory, but are the assumptions realistic? Let's take the first assumption, that an investor has reasonable knowledge. What is reasonable? How much detail about a company and their products is reasonable? I remember a time when analysts could describe in detail the production costs of a single copy of every copier offered by Xerox. Was that reasonable? Was that even important? How many investors had this level of detail? Now, with a high and increasing use of index funds, is the market being influenced by investors that have no specific knowledge or individual stocks or markets? Is that reasonable? In the case of an index fund, the manager is not making any judgment about the stocks or market, but investing billions of dollars in stocks because they are there. Is that reasonable? The second assumption assumes an investor knows what is in their best interest and makes decisions to advance these interests. I can tell you that in the 30-plus years that I have been managing money for individuals, that is not always the case. Emotions, history, children, college careers, taxes, and a host of other criteria complicate these decisions. Institutionally, business objectives, tax decisions, actuarial assumptions, and compliance decisions all influence stock selection and many times are not aligned with the financial interests of the investor. The third assumption is hard to imagine unless the investor is living alone on an island. Many of the reasons that are important in number 2 above influence investors, and they believe they must make decisions within a timetable. The fourth assumption has moved well beyond the premises of trades executed manually on the New York Stock Exchange. Today, is a reasonable amount of time measured in milliseconds? A reasonable amount of time is unique to the individual and is influenced by external factors. The fifth assumption is predominantly correct, but caution must be exercised so as not to fall into the age-old trap of it must be correct, it's on the printout, or the current false premise, it must be correct, I got it off the internet. Real life is not as clear-cut as the theoretical world, but we still must design a way of making good decisions in the real world. As a start, understanding the theory of fair value is important. It is based on the desire to purchase stocks when they are undervalued at a discount and sell stocks at some point when they become overvalued or expensive, hopefully after a gain has been realized. Buying undervalued stocks is based on the premise that undervalued stocks have a high probability of increasing in value, thereby returning to their true fair value. Overvalued stocks have reached a high point and will soon drop in value when the market realizes expectations are too high and will not materialize. If an investor applies a discipline of selling a stock once it has reached an overvalued position, and then reinvesting the money into undervalued stocks, the investor has a high probability of adding value to the portfolio. It is a straightforward process, but can be very difficult to apply in a disciplined manner. The first obstacle the investor runs into is determining fair value. The fair value for the stock is whatever two investors agree upon at that point in time. the price of the most recent trade is the fair value. That may be true for those two individuals at that moment in time. However, it may not be a fair value in the view of the market in general. Fair value also includes an estimate of future prices. Future price expectations can be different for each investor because each investor has a different time period. Some are short-term, others are long-term. A trader's fair value over the next 30 minutes is not the same fair value of an investor looking out over the next 3 to 5 years. An accountant will use what is called a discounted cash flow. This is a method of determining the current fair value of a company by discounting the profits generated into the future, then adding in the expected value or final disposal of the stock. The accountant's calculation assumes a static, predictable, stable environment. When was the last time you experienced such an environment in the stock market? The investment strategy network calculation of fair value is based on the fact that a large group of investors place high emphasis on revenues and the ability of the company to generate revenues into the future. Another equally large group of investors places emphasis on earnings and the ability to generate an increasing level of earnings into the foreseeable future. Additionally, many investors place emphasis on the company's desire to share success with investors through dividends. No single method covers the entire market. For example, if an investor only considered earnings, many companies such as Google or Amazon in their early days would be worthless. If investors only valued dividends, then companies such as Microsoft would have been worthless until the day they paid a dividend. The combination of these key fundamentals is what determines a market fair value because the market is made up of all of these valuations. The ISN fair value calculates a fair value based on revenues, earnings, and dividends with each other. The ISN fair value calculates a fair value based on revenues, earnings, and dividends with each other. These calculations are then stabilized to avoid chasing the recent price or sudden temporary changes in revenues and earnings. Data is examined for stability and consistency across several data periods. We believe a fair price needs to have stability to avoid overreacting to temporary market changes. Each of these three factors, revenues, earnings, and dividends, will have varying degrees of influence with different stocks. The next step in determining the fair value is calculating the importance each factor has on each individual stock and adjusting the fair value for the level of influence. This allows us to create a high level of confidence in the final calculation. The final fair value calculation is then used to create a combined fair value for respective sectors, industry groups, market capitalization classifications, and total markets. Our approach has been developed with one purpose in mind: provide an objective, long-term, reliable fair value that can be used as a base value. The base value is then used to determine whether a stock should be considered for purchase now, a buy, considered for purchase in the near future, a buy watch, considered for being removed from the portfolio now, sell, or that it should be monitored because it may become overvalued soon, sell watch. To learn more about this consideration classification, please see our discussion on that topic under Stock Considerations.